Hello, everyone. Today on the Final Bar, we'll talk about a resilient market with the S&P touching just barely almost that 3,700 level for the first time, certainly following through to the upside with energy leading the way higher. Utilities, the only one of the sectors down. So certainly this week, if you were waiting for some sort of upside confirmation, we've certainly got it. Now it's all about how the breadth measures continue to support it and how euphoric sentiment is compared to these trends. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, try to make sense of things, answer questions that come up in the natural course of analyzing market behavior. The good news is, by the fact that you're watching the show, that you're using StockCharts.com, you have one of the best toolkits, if not the best toolkit I have found over my career to help evaluate investor behavior and understand momentum, price trend. And, in general, your role as an investor is to answer three questions. Where are the trends? Number one. Number two, how can I follow those trends? And number three, what can tell me when those trends may be exhausting or when they might be reversing? And we're going to talk through the course of this show, wrapping this week on a Friday afternoon, what the signals are telling us. And overall, it's certainly continuing to push to the upside, sort of long and strong up and to the right. Things going well. So of course, my contrarian hat is flaring up, wondering when we were going to see some painful downturn, but we'll take the uptrend while we have it for sure. We have some wonderful guests. So super excited this week with some really good guests. We had yesterday, Ari Wald from Oppenheimer is just a really sharp analyst, had some great thoughts about small cap rotation, financial leadership. It was really worth seeing if you missed it. Next week, we have a normal Monday show as we address the market from three directions: top down, bottom up, and sectors. On Tuesday, the 8th, we have Dan Passarelli, who's an options expert, joining the show for the first time. On Wednesday, the 9th, we have Chris Vermeulen. And then on Thursday, we have Mark Young from Wall Street Sentiment coming back on the show. Two quick heads up on top of that. Starting December 21st, last 2 weeks of the year, we're going to run our special year-end programming called Reflections 2020. We just signed up Keith Fitzgerald, who's a fellow Seattle area native and does a really good job thinking about investor behavior and decision-making. I'm going to have a conversation with him about how he reviews the year, how he wraps up the year and looks at his performance and how he suggests investors do the same. We have Gaddis Rose doing a similar conversation. We have another set of interviews talking about sector rotation and having some experts present their sector and group themes. And then finally, one of my favorites, 10 days, 10 experts, each presenting their theme of the year, the technical theme represented through charts, what was noteworthy over the course of the year. It's going to be a lot of fun. Some really fantastic strategists giving you their latest charts and thoughts going into year end. So look for that for sure. Let's get to our wrap the week. This is where we take a look at the weeks and how they've how we've evolved Friday to Friday. Excuse me. I want to start with a poll though. Bitcoin obviously testing the 20,000 level, which is a pretty significant milestone by any measure. And so the question related to Bitcoin: where does Bitcoin finish the year 2020? And I gave you four choices. We started with above 22,000, between 20 and 22,000, between 18 and 20,000, or below 18,000. Most of us gravitated around that middle. So 30% said, sort of where we're at or 2,000 points higher, between 20 and 22,000. 26% of us said between 18 and 20,000. So about just over half, 56%, almost 2/3 to be honest, said sort of within this general range that we're at, not too far from current levels. 21% of you said below 18,000, 24% of you said above 22,000. So what's most striking is not which got the most votes, but the fact that it's not that different from top to bottom. We're sort of there's no real clear winner between them. And I think that's about right. I mean, Bitcoin has had such a run. If you look at the chart of $ BTC/USD, which is how you can look at the Bitcoin rate on StockCharts, you can see it's obviously a huge run from 4,000 less than a year ago to 20,000 just a week or two ago. We're just below 19,000 currently on Friday afternoon. So we're sort of looking in that range from from 18 to 22,000 and beyond, and it's sort of spread all around there. And what's funny is I think you could make a technical justification for all four of those votes. So I don't blame you for not having a clear answer. What would I suggest? I would probably guess it finishes the year in the third category between 18 and 20. I think there's a bit of a backing and filling that could happen. I think long term, I certainly could see further upside, but I would guess a little more choppiness. We'll see what happens. Let's wrap the week. So we're going to start with what we see in today's trading. We're going to build that out and look at some of the longer term charts using the Mindful Investor Live chart list. The S&P finishing strong, as I mentioned, finishing just right below 3,700, just quite there, around 0.9% higher. Mid caps and small caps even better. So this theme I talked about with Ari Wald yesterday about small cap leadership, and honestly, it's something we've been discussing. A number of my guests have mentioned this rotation from growth to value, from large to small. New sector leadership themes, and certainly we've seen the follow through today among many days with the S&P 600 up 2.5%. The Nasdaq 100 actually lagged behind the S&P, and this continues this I guess ending of leadership of the FANG stocks. Although they could certainly recover, they certainly haven't been the story recently. It's energy, financials, materials that are really getting it done. The VIX is back below 21 again today. Looking at some other asset classes, the TLT went lower about 1.5% today. It was a pretty strong down move. 10-year yields are very close to 1%, which would be a pretty significant level, I think, psychologically, but literally as well. Metals were mixed today, with gold down just a bit and silver up. An overall sort of flat. Cryptocurrencies came off pretty good today, with Bitcoin down 2% and others down much further than that. Let's look at our wrap the week, and so much apologies that I didn't actually have a chance to set up this chart yet, but we're going to look at it anyways. Here we go. This is looking at the asset classes. The labels aren't going to be correct on here, so I'll do my best to point out what happened. The S&P is here in black, so it was up about 1.6% for the weeks. This is from Friday's close to today. Now, obviously, last week we had the Thanksgiving holiday, so it was a shortened week. So that's sort of a given. It's going to be a little weird coming off of a lighter volume day, but overall, it's still a fair thing to look at. So what underperformed stocks this week? EM was actually up 1.6%, really close there in orange and brown. We have crude oil up just above 1%. What lost this week? This is the U.S. dollar in the form of the UUP, down 1.2%. And the biggest loser were bonds in the form of the TLT, down 3%. What outperformed the S&P this week? In purple, we have small caps up 2.1%. In pink, we have the Nasdaq 100 up 2.2%. Gold is in the gold color, up 2.7%. The big winner for this week, Bitcoin, up 10.8%. So, it's funny. I used to run these asset class charts without Bitcoin. And the moment I add Bitcoin on there, it was often way above or way below. It's certainly an outlier. There's way more volatility, but obviously way more opportunity. Volatility means opportunity. I remember talking with Fred Meisner from the Fred Report months and months ago when we used to be able to see people in person, visited him in Atlanta, and talking about that. And, he was, and Charlie Kirkpatrick, actually one of my mentors, used to talk a lot about how, we tend to think of volatility as a bad thing. And a lot of quant models consider volatility bad. You want good returns with low volatility, right? But for a technician, for a trader, volatility equals opportunity. Without volatility, there's no real opportunity to take advantage of. So let's go where the opportunities lie. Let's continue on looking at the Mindful Investor Live chart list. And we've sort of seen what's happened this week. Let's dig into some of the broader themes and get to whatever we can. We'll go with this list here. If you've not seen this before, just go to my page, click on articles, go to the Mindful Investor, which is my blog page. At the top, you'll see a link to a live chart list. It'll get you right to here. The market trend model has been bullish for quite a while. The long-term model turned bullish in June. The medium-term model, a bit of a head fake in October, but turned back positive in early November, remains positive. And the short-term model has been positive for the last 6 weeks or so, 5 or 6 weeks. So these are all based on weekly exponential moving averages. This first chart shows you the combination that we're using. The long-term is built on the 21 and 34-week exponential moving averages, has remained very positive. The short-term is simply looking at where we're at relative to the 5-week exponential moving average, also positive. So, the trend, as a trend follower, the trend is up, and you want to own stocks when the trend is up, is the back of the envelope game plan there. The daily chart of the S&P really drives home this, this transition from rally mode from late March to early September, consolidation mode, which is what September and October really were. And we talked about this range, 3,200 to 3,600, the blue shaded area on the bottom, the green shaded area at the top. That held very well through the month of October. It felt like a pretty good reference point. We teased those levels for about 2 weeks here in mid-November, and that's the question I had, especially with the move up to 3,600 and back below. It sort of felt like that was the top. The top has been eclipsed, so and we've now closed above. We've retested and followed through to the upside. I think this week was certainly pivotal in confirming an uptrend. If you were skeptical of the market going higher, I think you have to acknowledge we're moving higher at a pretty good clip here. So what's interesting is we've talked about how we were facing resistance, which was sort of negative, sentiment getting a little more bullish, which was becoming more of a contrarian negative signal. The problem is we're at the seasonally strongest part of the year. So what does the market do when the coronavirus appears to be getting worse, when any headlines you see related to that certainly seem more negative than positive? But we're at the seasonally strongest part of the year, with people obviously doing a ton of spending, going into the end of the year holiday season. And overall, the market is suggesting that nets out to a positive. And again, you don't have to think about what should happen. Look at what is happening. Stocks are going higher, and when that stops, we'll stop talking about a bull market phase. That uptrend in price has certainly been confirmed by breadth. And if you look at breadth in the form of the advanced decline lines for the NYSE, for the S&P 500, so large caps, then mid caps, then small caps, you can see they're all color-coded green because they are all confirming new highs. They have now all gone above their high from earlier in the year, either January, February. All 4 of those have made new highs for the year and continue to make higher highs and higher lows. The trend is positive in price and in breadth. Another way to think about breadth that's actually kind of interesting is looking at the highs and lows, or rather the new highs and lows. This is showing you every day on the New York Stock Exchange and then the S&P 500 and bottom, how many stocks every day are making a new 52-week high and a new 52-week low. The green bars, obviously, new highs. The red bars, which you have to look back a little bit to actually see any red bars, that would mean new lows. You can see, for months, very few new lows. Really, since May is the last time you saw a legitimate number of new lows. Here in late October, you just started to see, just the tiniest amount. But again, it's so few relative to what would happen in a bear market phase. This has sort of been in bull market range. I think one of the interesting things here is after the big spike higher first week in November, you see both of these went up, and at its peak, 30% of the S&P made a new 52-week high. There that first into the second week in November. Since then, it lightened up quite a bit as the market sort of chopped around that 3,600 level. But if you look on the up days, when the S&P's closed higher, you can see that there's been a pretty decent amount of stocks making new 52-week highs. So this is sort of in the 8, 10, 12% range. You can see it's 50, which, 50 out of the S&P 500. That's the math. So, a pretty good amount. So it's not bad. It's actually consistent to what you saw back here in like July and August on this stretch where the market was continuing to push to new highs. That's about what you saw on the good up days. So that's good. What's interesting is it's not anywhere near a euphoric stage, as I would describe it, right? This isn't telling you so many stocks are making new highs. It's probably the end of something. It's not really the case. In more extended bull market phases where the market really gets to new highs and accelerates, you'll get many, many more stocks making new 52-week highs. So overall, suggesting a fairly healthy uptrend. I will put on my contrarian hat on for a couple charts, and this is one of them. This is the S&P 500 and the percent of S&P stocks above their 200-day moving average. It was at 92% at the end of the day yesterday. I would imagine, based on what we saw today from stocks, that might go up a point or two. We'll have to see how things net out. And so you can see by this blue dashed line how often that happens. This is going back 5 years, and it's never happened. And it happens rarely. And if you look back the last 15, 20 years, you will see that It has happened. It just doesn't happen that often. When it does, two things I would generally take away from that. Number one, it is long-term bullish. The market is rarely down 6 to 12 months after you get that sort of reading, because so many stocks are in uptrends. The momentum is so positive. It's rare that that would be it, that would be a blow off top. That's usually more of momentum, of the steam building. But it also often will lead to some short-term down movement, right? Because so many things are moving up. A lot of times that'll be a bit of a pullback. So that short-term pullback, long-term uptrend thesis is kind of what that would historically line up with, which is an interesting data point. The AAII survey, you can just see by the shape of this curve over the last couple months how much this has changed. 3 months ago, as the S&P was breaking to new highs here in August, you had only about 25% of respondents in the survey being bullish. You had about 35%. Excuse me, this is actually, this is even more. It's like 45% of respondents bearish. So, it was leaning very heavily to bears over bulls as the S&P was going to new highs. Fast forward a couple months to once again going to new highs, threatening 3,700. You have the opposite. You have 50% of respondents now bullish. You have only 23% that are bearish as of Thursday's reading. So what does this tell you? Where if you look back, it is, again, it's not common that we are this high in terms of bulls. The spread actually has happened a little more often. This is the difference between the two of them. But if you look at the green and the red histogram here, the percent of respondents being bullish at 49%, above 50% is fairly rare. You will see that happen a lot at market tops, and it won't often be exactly at the top. It'll be a little before that. So if you look at the 2017 to 2018 January peak there, we got over 50% here in December. It was about a month later when you had that first leg down, which felt pretty painful at the time. So, it is common, and this is a similar pattern to what you see at major market tops. Here's the problem. You also see it at extended bull markets. So here in November of 2016, you can see that we had a similar reading with about 50% of respondents being bullish. And then we led into 2017, which was a much stronger uptrend. So for me, sentiment indicators like this are anecdotal. There's a reason why I have 3 steps. Price is first, breadth is sentiment, sentiment is third. And the reason is because it's in priority order. Price tells you how people are voting with their capital. This tells you how they're voting, and it's a subset of investors, individual investors, telling you what they think about the markets. However, I am always fascinated when I see some contrarian signals. This is how I would categorize this as a contrarian sell signal, suggesting sentiment in the form of this survey at euphoric levels. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday after the close for the Final Bar, especially on a Friday. It's one of my favorite. It's part of my weekly routine, really. It starts on Thursday as I get a note out to clients, get ready for this show on Friday, and then, just grab some time over the weekend into Monday to review a lot more charts and think about how the picture has changed. But this is a really good exercise, and I hope you find that this is able to be a part of your own routine, weekly routine of understanding market structure and how it's changed. We're going to open the Final Bar mailbag here momentarily. As a reminder, best way to get your questions to us is via email, thefinalbar@stockcharts.com. We'd love to hear from you, feedback on the show, and particularly questions that are coming up as you are analyzing your own charts. Let's get right to the questions. Number 1, please give us your observation on Virgin Galactic. That's SPCE. I brought that up here when I saw the question. It broke out of major resistance back this summer when I made my last observation. I remember that. Do you think it will hit 42 again? Thanks. Hope you had a nice Thanksgiving. And I hope you did as well. I hope everyone stays safe through the end of the year here for sure. This is the chart SPCE. I threw on here. This is sort of my standard stock chart that I would use. And, so a couple things come to mind. Number one, if you ask me to overall, is this leaning higher or lower? It's certainly leaning higher. And I like the fact that we tested the July peak. Virgin Galactic's a little different. A lot of stocks had a peak in June, kind of chopped around, thinking of like financials and energy and other things, but Virgin Galactic actually topped out in July and then has sort of been in a range-bound pattern since then. It broke out of that sort of consolidation pattern, and now getting above the July high, I think was pretty key. So I didn't put this line on here, but one line I would certainly be looking at, this one, right? So that's taken off of the the July high. We're sort of right there. Overall, I think that's appears to be a pretty good breakout going on onto Friday. I think if you would pull back, I'd certainly be looking back at this previous low from the last week or so. It's just about 25 or so. That would be a pretty reasonable point on a pullback as long as we remain above that. I think the trend is still positive. The only concern I have on this chart right now is we're right at that last Fibonacci level, which is the 61.8% retracement level, just below 30. I would love to see a breakout above there. And I think, the fact that we've gotten to this point is impressive. The fact that we've broken above the July high is impressive. I see us being overbought right now, right at this Fibonacci retracement level, which is sort of a tap the brakes kind of signal for me. What I would want to see is a break above 30, a confirmed breakout above there. I think that clears the way up to a return to previous highs at 42, because beyond that, there's really nothing left on the chart besides the previous high. So great question. I think overall it's setting up pretty nicely on any of these stocks that have had a pretty good run in November. Use those previous swings. That's where you want to be bumping up a stop and just continue to lock in gains. Good chart though. Question number 2, this may be me being impatient with a long-term setup. I keep looking for a pullback since September, and you're talking about the S&P 500, which we'll look at here. I know technical analysis can sometimes get creative. I love that, based on what the individual sees or wants to see. So I'm asking if I'm maybe interpreting this pattern wrong. Can you see a bearish harmonic butterfly in the S&P starting with September? So I did read this ahead of time. I put this together. This is using ACP, which is our new advanced charting platform. So we do have a Gartley pattern, the XABCD pattern that's built into this. This is what I use. So what you're basically saying, this is the run up into the September peak. And I would agree with you. This does look like a butterfly pattern, which is, the peak, the pullback, a subsequent rally that gets, I don't remember the numbers, like 70.78 or something back here, higher low here, which is your C point, and then the D actually goes above these 2 points. And it's similar to some other sort of Gartley patterns that you might see that just have some different relationships between peaks and valleys. Now, I will caution you right off that this is not my main area of expertise. I did not consider myself a harmonics expert. I would say the good news is we do have some of those as contributors. Leslie Juflas, who's one of our fellow contributors, just recorded a video on this in the last week. If you look at our YouTube channel, it's called Your Daily 5. Her name's Leslie Juflas, and the title of it has something to do with a butterfly pattern. She did a really good job describing this. So her levels are a little different than mine. But one of the things I noticed is when you're looking at a butterfly pattern, a lot of times you take this, X, the A, the B, which gets back, near that point. You take the height of that and start projecting that higher. 38.2% is where we're at. I think usually you get up to around 61.8% is usually the objective, which means we could have a little bit more to go with that one. But I would watch Leslie's video and see what she has to say. She was using some other points and making some other Fibonacci projections that might help you make sense and qualify what I just said there. Thanks so much for the question. Next one, on Twitter this morning, a person I follow posted this following chart, unfortunately on a different and quite obsolete and not as good platform. I may have embellished your comment just a little bit, but it was from another platform. I noticed he had drawn the lower trend lines to a 5-degree slope to horizontal, then match that slope when he drew the upper trend line. Yeah, so I'll summarize your question. What you had said was basically someone did a trend line and said, okay, that's a 5% angle from horizontal. It's 5% down. So I'm going to take the same, low point and do a 5% down, and I don't think it was the S&P, it was something like that. So your question is that a common, an accepted practice in the world of technical analysis, or is it more arbitrary? So here's one thing. It's a really good question. I have seen people use those angles, and where I've seen them use them the most is with Gann analysis. If you follow someone who does Gann, work of W.D. Gann, who did some amazing pioneering work in the early 1900s relating price and time. And I followed a number of people that had some of them on the show, like Jim Smith from Catapult Research we've had on, and some others. They actually do angle lines. They talk about 45-degree lines. They have 0 lines and different angles, 1 by 1, 1 by 2, that look at the relationship between price and time. Personally, I found angles like that to be very arbitrary, only because you have to have a very steady y-axis and x-axis relationship, or using arithmetic or log scale charts. All of that can change the way that you would do things. And someone like Gann was using arithmetic charts. Now I would argue it the best way to represent trend is using log scale charts. So having said that, I would say that the idea of using a particular angle seems a little kludgy to me. Looking at parallel lines, I think, is absolutely correct. And I think that's one of the things he was definitely getting at. And I would say, if you're interested in that sort of analysis, I would look at some analysts that do Gann and see what you can find and see if it fits into you. For me, though, I think with things like that, with specific angles and saying, and to be honest with you, it's one of the challenges I have with some harmonic patterns. For me, it implies a perfection, a symmetry that is idealized that I rarely find actually plays out in real life. Those are our questions. That's our mailbag for today. I want to thank you guys all so much for sending in some really thoughtful questions. Made me think a little bit as I was thinking of how to answer those. As a reminder, shoot us an email, thefinalbar@stockcharts.com, with what's on your mind, and we'll hope to get to it in a future mailbag segment. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the TLT. This is the long bond ETF that we looked at earlier in the show. A number of different ways you can look at bond prices, like the AG, AGG, government, GOVT, are all fairly liquid ETFs that can help you track bond prices. I tend to use the TLT because it's a fairly liquid one. It's one I've used for a number of years. Bond prices down today, yields getting higher, and we've talked about that pattern, that rotation away from bonds into stocks. The stock to bond ratio clearly favoring the S&P over the TLT for sure. What's interesting about the TLT right now is it's actually testing its 50% retracement line. If you look at the November low and go to the peak that you saw in March, this is that really choppy period around the S&P market low as well. Since then, and since the rotation in April to July, it's been in a pretty consistent downtrend. Lower highs, lower lows. It's broken down through the 200-day, retested that from below. The Fibonacci retracement level, I think, was a really telling one. Now it's testing the 50% line, which makes me think is if it breaks that, which it appears likely to do, we go down to 150 on the TLT, which would be a 61.8% retracement. At that point, you reevaluate it. If you flip this over, that's sort of what the 10-year yield looks like. It's almost like a cup and handle bottom, and you're really close to validating that breakout. 1% would certainly do it. Chart number 2 is $XNG. This is the natural gas index. It's not looking at natural gas futures or anything. It's looking at companies that are in the natural gas space, and it's an equal weighted measure of a group of stocks that are in natural gas. I just thought it was an interesting rotation. It certainly looks like an inverted head and shoulders of sorts. We have the low here in March, and then you have some higher lows on both sides. This trend line, which is what we'd call the neckline, certainly broken. I'm taking the trend line back from here. If you are a head and shoulders aficionado and you follow Edwards and McGee, by rule, you connect these two, in which case we just broke it, and that's how it got on my radar. So now I think the final tell is, does it rotate above this August peak? The fact that natural gas stocks are breaking out to the upside is pretty impressive. The relative strength starting to improve. Still a long way to go to catch up to others, but I think along with energy, starting to look pretty powerful. The semiconductor index, the SOX, is one of the better charts that you will see out there. We talked about the long-term relative strength in the XLK, but look at how the semiconductor stocks have continued to do well. Stocks that are good offense, meaning they outperform in up markets, and good defense, outperforming in down markets. Those are the types of things I would consider a core position. This is what you'd want to build a portfolio around and stick with things that are working in pretty much any environment. So the SOX index or the SMH, 2 ways to certainly play that theme. Folks, that is our show for today, and that is a wrap for this week on The Final Bar. I want to thank you so much for joining us on the show. A lot of great ways you can interact with us, and we'd love to hear from you in terms of questions and feedback. thefinalbar@stockcharts.com is our email, or on Twitter @finalbarsctv. One quick announcement going to the end of the week. We are finalizing a beta version of our new StockCharts TV on-demand platform. It's going to be web-based and coming very soon to a mobile device that you might have in your pocket or on your desk. So be looking for announcements from us very soon on how you can access that new beta version of StockCharts TV on demand. From all of us here at StockCharts.com, StockCharts TV, have a wonderful weekend. We will see you next week. Take care.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.